Good morning, everyone. So this is your last class on the revisionary classes. This is the last one as far as financial reporting is concerned, and quite a um, uh, technical standard to sum up everything, whatever you have studied. That is Ind AS 101. That is your first time adoption of Ind AS. So this is a standard that has maximum practical utility because any entity that moves from IGAP to Ind AS is required to apply the Ind AS 101 principles. It is applicable at the time of transition. So your Ind AS applies when either it becomes a listed entity, either its debt or equity securities are listed or to be listed on a stock exchange, or your net worth exceeds 250 crores. So this is your mandatory applicability of Ind AS, or if you want, you could voluntarily go ahead and apply Ind AS. Then also 101 principles will apply. Acha. Now, the key point to remember is whenever I transit from gap to Ind AS, this becomes a policy change. This becomes a policy change. And therefore, by virtue of it becoming a policy change, we will have to do a retrospective application. We will have to do a retrospective application. That means a retrospective restatement will apply. That means a retrospective restatement will apply, which means you will have three balance sheets: end of current year, end of previous year, and beginning of the previous year. So these are the three balance sheets and the two columnar P&Ls, current year and previous year, that you would be having. Are we okay with this? Yes. So these are the initial key pointers that we have when we start off with this standard. Okay. Now, uh, what we will be seeing is, as part of the revision, we'll try to go through all the adjustments that we have already done. So I will be taking you through the content that was already there for the main session. So I will be running you through that as well as the study module. So I think that should be sufficient for us to get a bird's eye view of this chapter in totality. Okay, so now when we come to your major points, first one is first Ind AS financial statements. What do you understand by first Ind AS financial statements? This is the first annual financial statements in which an entity adopts Ind AS with an explicit and unreserved statement of compliance with Ind AS. So what is my first Ind AS financial statements? This is the first time when you adopt, and it must be accompanied with an explicit and unreserved statement of compliance. So you move and you also give a statement of compliance. And remember, this is an explicit and unreserved. That means you cannot say subject to the principles of, let us say, Ind AS 109. All others we have moved to Ind AS. You cannot do like that. It must be all or none. Okay, so it's either all or it is none. You cannot have something in between. So you need to give an unreserved statement of compliance, and that will be your first annual financial statements. So what is important is compliance with all the Ind ASs. Okay. Now, what would be the scenario? What would be the scenario if auditor expresses that a particular standard is not correctly applied, but we as the management have done the application in a particular manner? Would that mean, and we have given an unreserved statement of compliance, but auditor feels that the treatment should have been done in another manner? So would you say that giving that unreserved statement is incorrect? Answer is no. Unreserved statement is correct. Where the auditor feels a standard has not been applied or converging adoption principles have not been applied, in that scenario, auditor has the freedom to mention it in his audit report. He has the freedom to mention it in his audit report, but that will not stop you from giving the unreserved statement of compliance. So that is the first part. Now the second definition that we have is, what do you mean by date of transition? What do you mean by date of transition? The beginning of the earliest period for which an entity presents full comparative information under Ind AS is in the first Ind AS financial statements. So basically, your transition date will be the beginning of the first period when you are going to apply the Ind AS principles. So if we'll have to look at this question, an entity is required to adopt to the Ind AS from 1st April 20X1 with comparatives for X0, X1, that is the previous year. So what will be the date of transition? So X1, X2 will be the current year when you are going to apply. X0, X1 will be the previous year. And 1st April 20X0 will be the earliest period. That is the beginning of the previous year. So your date of transition will be 1st April 20X0. So that is your date of transition to Ind AS. Okay. And then we move on to the next one, that is uh, previous gap. Now I'm only covering the major definitions. So others you could read up at your own end. So what do you mean by the previous gap? Previous gap is the one that was used by the first time adopter just before adopting Ind AS. Okay, so that becomes your previous gap. So normally in India, you will have the regular accounting standard regime that is currently in force. That would typically end up becoming your previous gap. Are we okay with this? Yes. Are we okay? Any doubts? No doubts? Please there. Okay. So that is your previous gap. Uh, So, basis of accounting that a first and adopter used for its statutory reporting immediately before adopting Ind AS. That becomes your previous gap. So, you are going to convert from previous gap into the current Ind AS financials. So, that is the meaning of previous gap. Okay, now we move on to the next one. That is, we covered three important definitions. First, Ind AS financial statements, date of transition, and previous gap. Now, when I talk about adoption, try to picture a scenario. I have accounting standard based financial statements and I have to move towards Ind AS based financial statements. So what are the activities that you will be required to do? What are the activities that are required to make this transition? So the first activity is you recognize all assets and liabilities which are required to be recognized in Ind AS but not required or not recognized under the previous cap regime. Kya bola? What did I say? The first one is recognize assets and liabilities which were not required to be recognized under accounting standard regime. Are we okay with this? So first point is recognize. Second point is there may be some assets liabilities which you have recognized under accounting standard regime, but under Ind AS, they should not be there. So therefore, de-recognize assets and liabilities which are not required under Ind AS, but which were required under AS. Then the third one is reclassify. Reclassify means what? You reclassify under the appropriate head of the Ind AS. And finally, what do you have is apply the measurement principles for all assets and liabilities. Are we okay with this? A four-step process. It is a four-step process. Okay? Yes? Any doubts? So general principle, recognize all assets and liabilities. Do not recognize if Ind AS does not permit such recognition. Reclassify items that it recognized in accordance with previous cap and apply Ind AS in measuring all recognized assets and liabilities. Are we okay with this? Yes? Any doubts? Uma? Lavanya, any doubts? Okay, fine. So that covers. Acha. Now the general principle that we just saw: recognize, derecognize, reclassify, measure. Would these principles exist even if Ind AS 101 was not there? Would these principles exist even if Ind AS 101 was not there? What do you think? Let us suppose Ind AS 101 was not there. Would you still apply these principles? Yes. Feel free to answer. You don't have to hesitate. Okay. Oh, Swaminathan is here. Okay, fine. Oh, yeah. Is it clear? All right. Basically, these four principles, even if Ind AS 101 was not there, you would be following it. You would be following it. This is not specific to Ind AS 101. What Ind AS 101 seeks to do is, it seeks to simplify your life at the time of adoption of Ind AS. It seeks to simplify your life. It seeks to give practical exemptions, practical where you face practical difficulties. It seeks to give a turnaround. It seeks to give another way, another path in which you can ultimately say you have converged to Ind AS. So therefore, you are going to have certain treatments in this particular standard, which would be an easier way of implementing a particular Ind AS. It would be an easier way of implementing a particular Ind AS. That is why 101 was brought about. That is why Ind AS 101 was brought. Is it okay? Yes. So now let us look at recognizing all assets whose recognition is required by Ind AS, but they have not been recognized. Okay. Now, tell me, have you studied financial instruments? Yes. Have you studied financial instruments?
Yes, sir.
Yes. In financial instruments, you remember having studied something called bills discounted? Yes. Okay. I will just cover it up in brief if you are not able to recollect. Yes. See, the principle works something like this. Okay. Okay. Now let us suppose I have two companies, A Limited, B Limited. Okay. A Limited has sold goods to B Limited, and uh, it has taken a bills receivable from B Limited. Okay. So A Limited has sold goods on credit, and in return, B has given a bills receivable. Yes or no? So now let us try to understand this. Okay. What would be the entry under accounting standards? First one, B Limited account debit to sales. Do you agree with this? Yes. And what B Limited
Yes.
would pass? What B Limited would pass? Purchases account debit to A Limited. Are we okay with this? Yes. This is the first entry. Second entry, A Limited draws a bill on B Limited. B Limited accepts and sends back the bill. So here the entry will be what? Bills receivable account debit to B Limited. Do you remember these entries?
Yes, sir.
Yes. Do you remember these entries? Yes. Then what entry would happen? A Limited would get this bill discounted with the bank. So what would be the entry? Bank account debit, interest expense debit, bank will charge some interest to bills receivable. You remember this was the entry that was passed? Yes.
Yes, sir.
And here, no entry for discounting. Okay. Now, can you see this? Bills receivable debit, bills receivable credit is getting knocked off. Yes or no? It is getting knocked off. Yes. Am I right? This is as per accounting standards. This entry is as per accounting standards. Under accounting standard regime, this entry is totally fine. Now, tell me from a transaction perspective, is A Limited's relationship with that instrument over, or is something still pending? Is A Limited's relationship with that instrument complete after discounting, or is something still pending? Okay. Let us suppose on the due date, B Limited does not honor the bill. Let us suppose on the due date, B Limited does not honor the bill. Whom will the bank collect the money from? A Limited or B Limited? Yes.
B Limited, sir.
See, understand first. A Limited got the bill. A Limited goes to his bank to discount it. Goes to his bank to discount it. Do you think this bank will know who is B Limited? Yes.
Don't know, sir.
If they will not know, you can't expect the bank to know who is B Limited. Does the bank know A Limited? Yes, he is my customer. So what the bank will say, look, I am discounting and giving the bill to you, but on the due date, if it is not honored by B Limited, I will collect the money from you. The bank will tell A Limited. Yes or no? On the due date.
Yes, sir.
Yes. That means in the books of A Limited, is there a liability existing if this bill is not honored?
Yes, sir. There will be liability.
And that would be a financial liability because it is an obligation to deliver cash. Yes. But under AS regime, am I showing the financial liability anywhere? If you
No, sir.
look, B Limited asset, B Limited liability is gone. Sales is a nominal account that goes to the P&L. Bills receivable, debit, credit also is gone. So is there anything which is showing that a financial liability exists? Answer is no. And that is why we have to recognize. That is why we have to recognize an asset and a liability in this particular case. I have to recognize an asset and a liability in this particular case. Are we okay? Yes. A
Yes, sir.
Limited will recognize an asset also as a Q because A Limited is still to receive the money from B Limited. Yes or no? So that asset also has to be recognized and a liability also has to be recognized. Are we okay with this?
Yes, sir.
Yes. So this is the example of recognizing assets liabilities which were not required under accounting standard regime. The next example, do not recognize items as assets or liabilities if Ind AS does not permit such recognition. If Ind AS does not permit such recognition. Hypothetically, let us take a case where proposed dividend before the amendment was recognized as a liability under accounting standards. But under Ind AS, you can recognize proposed dividend only after shareholders' approval. So therefore, you will ultimately, what you can say, you will ultimately de-recognize that liability because you have to recognize it only at the time of payment. Are we okay with this?
Yes, sir.
So, derecognition of an item which was permitted to be recognized under accounting standard regime. Then you have reclassification. Can you tell any example of reclassification? Preference share capital, which is shown as preference, which is shown under share capital under AS, you'll have to move it to non-current or current liability depending on the date of maturity. Yes, depending on the date of maturity. So that is one example of reclassification. Then investment property. If you are showing it as property, plant, equipment, you will now have to move it to, if you are showing it as PP, you will now have to move it to investment property. Are we okay with this?
Yes, sir. Convertible debentures.
Convertible debentures. Convertible debentures is not, I will not put it under pure reclassification, because what happens is in convertible debentures, you have to measure it as per Ind AS and then you will do a split accounting. Yes or no?
Yes, sir.
This I was speaking about purely redeemable debentures. Okay, you show them under share capital, but now you have to, under Ind AS, move it to liabilities. Yes or no?
Yes, sir.
And finally, apply Ind AS principles in measuring all assets and liabilities. That is going to go without say. That goes without say. Is it okay? Yes. So these are the four things that we have. Yes. Uma, are we okay? Saminathan, are we okay? Yes. All right. Fine. Okay. So now we move on to certain adjustments, and I will run through what we have already covered in the class so that we can cover all the adjustments as part of the revision, right? Because if I sit writing, we'll cover only 2 to 3 in the entire session. We don't have that luxury. Okay. So now Ind AS comes to help you out. Ind AS comes to help you out with certain specific exemptions, certain specific guidance, certain specific relaxations. Okay. In ordinary course, you would not do that. But because this is first time adoption, you are going to follow this. Okay. So now, first one, we start off with ESOPs. We start off with ESOPs. Now, ESOP, we divide into 3 categories. The first category is date of transition 1st April 22, grant date 1st April 15, vesting period 3 years, exercise period 1 year. That means in 4 years, entire life cycle of the options is over. And after that, you are going to transition to Ind AS. Will it have any impact on adoption? Will this have any impact on adoption?
No, sir.
No. Options only are not there. For options to be there, what should be there? You should be having SBP reserve sitting in your balance sheet or stock options outstanding account sitting in your balance sheet. You will not be having that. You will not be having that. And therefore, when no options are outstanding, there won't be any impact on transition. Are we okay with this? Yes?
Yes, sir.
Okay. All right. Then we move to the second scenario. So first case, you don't have anything to do. Second case, you have the date of transition as 1st April 22. Grant date is 1st April 15. Vesting period is 5 years. That means by 31st March 20, options would have vested. And thereafter, you have an exercise. Thereafter, you have an exercise period for 5 years. That means what? On the date of transition, is the vesting period over?
No, sir.
Check, check. Grant date 1st April 15. Vesting period.
Yes, sir. Yes, sir. Excess period is pending, but vesting period is complete.
Yes. Your vesting period ends on 31st March 2020. Whereas your exercise period starts from 1st April 2020 till 31st March 2025. Yes or no? Yes.
Yes, sir.
So now tell me, grant or vesting period is over, exercise period is pending. So can I say that all expenses necessary for this particular stock option plan, can I say they have already been recognized?
Yes, sir.
Yes. Uma, are you able to follow? Expenses have already been recognized. Now, under accounting standard, how would I recognize these expenses? I would recognize it based on intrinsic value. I would recognize it based on intrinsic value. Ind AS does not allow intrinsic value. You will have to do it at the base on the basis of fair value. You will have to do it on the basis of fair value. Are you okay with this?
Yes,
Yes,
sir.
you have to do it on the basis of fair value. So apparently, the SBP reserve, which is created and existing on the date of transition, that would be at intrinsic value or fair value?
Intrinsic value.
That will be at intrinsic value. I hope, Uma, I hope you are understanding, right?
Yes, sir.
Sure, don't hesitate to answer. Okay. So on the date of transition, your SBP reserve is already sitting at intrinsic value. Will there be any addition to this? Answer is no. There will not be any addition to this. Why? Because in this particular case, the vesting period is over. So what ideally should happen if Ind AS 101 was not there? You would apply everything at the time of transition. Yes, you would not look at anything. You would apply everything at the time of transition. And what would you have done? What would you have done? What was there at intrinsic value, you would convert it to fair value. Yes or no? Bolo.
Yes, sir. Yes, sir.
Yes, you would convert it to fair value. Uma, are you able to understand? Swaminathan, are you able to follow? Yes. So now the standard takes a slightly lenient position here. The standard takes a slightly lenient position here. What is that lenient position? The standard says that, look, since all the expenses are already booked before the date of transition, before the date of transition, you need not make any further changes. That means whatever expenses you have already booked, you will not modify or add or reduce the expenses to match with the fair value of the option. Are you able to follow? Yes?
Yes, sir.
Sure. So here EBE expenses are already booked. So therefore, you are getting an exemption. You are getting an exemption. Since everything is booked, you need not consider him for uh, moving to fair value based accounting. You can keep it at intrinsic value and then you can do the exercise. Are we okay with this?
Yes, sir.
Yes. All right. Third case, the last case of ESOPs. You have issued stock options, then you transition to Ind AS, and then the grant date gets over. Then you have your uh, then you have your exercise period. So in the third case, your transition period exists in the middle of the vesting period. Are you able to understand? Yes. Are you able to follow?
Yes, sir.
So now in this particular case, am I still having expenses to be booked? Am I still having expenses to be booked even after transition?
Yes, sir. Since vesting period is pending, we still need
Since
to book
vesting
it.
period is pending, you still have expenses to be booked. So in this particular case, the standard says that you are not going to get any transition relief. You will have to, based on best information available, you will have to restate the SBP reserve, which is appearing at intrinsic value. You will have to restate that to fair value and then calculate the EBE for the balance months of transition. Are you able to follow? Yes.
Yes, sir.
Okay. So three possibilities, three different ways of treatment. Are we okay? Yes. First case, options are vested, exercised, and then you transit. Nothing to be done because it is already the options have already vested and exercised. Nothing is pending. Second case, options vested, not exercised. You can continue with the same value. So that is a benefit that is given under 101. Third scenario, you will have to go to the, what you can say, you will have to go to the complete implementation, even though it could be, what you can say, even though you could be having something in the middle of the vesting period, you still have to deliver the, even though it is in the middle of the vesting period, you still have to deliver the SBP reserve at the fair value. So therefore, no exemptions. Use the best available fair value for doing the accounting in the vesting as well as in the exercise period. So that closes up on ESOPs. Any doubts as far as ESOPs are concerned?
Sir, in the third case means we should apply fair value on the grant date and do retrospective accounting, sir, till date of
Yes,
transition.
yes. Fair value on the grant date you should find, but it is not so easy. It is not so easy. Okay, because grant date would be some past date, so you have to go back in time and do the accounting. Yes or no? Yeah,
Yes, sir.
but that is the best way of doing that, and that is what is preferred. Okay.
Sir, what about that? There will be previous reserve already created as per previous gap, no, sir. We should will be
So
transferring
there is an
any.
existing reserve that is created as per previous cap. Now you will restate that reserve, correct?
Yes, sir. Means we
So
will
the
adjust the
dif-
balance to that existing reserve.
yes, so the difference you will take it to retained earnings.
Okay.
Okay,
Yes, sir. Yes, sir.
the difference you will take it to retained earnings. All right, fine. Share based payments. Okay, so that is about ESOPs. Any other doubts, Swaminathan? Any doubts? No. Okay. So even Lavanya is clear. Now we move on to the next item. That is foreign exchange. Now, this also we have covered it in detail in the session, but just to uh, quickly run through the provisions. Uh, there was para 46, 46A under AS11, not was, it is still there. Okay. So what happens is under this particular standard, under these two paras, what was the option that was given is foreign exchange gain or loss that you are making on long term loans. You have taken a long term loan. Because of that long term loan, you are having foreign exchange movements, you are having foreign exchange fluctuations. Now, you have two options under the accounting standard. First option, you take the hit to the P&L. You take the hit to the P&L. So this happens regularly. There is no change. You would have done that even without any specific guidance that is required. Okay. So first option, take the difference to the P&L. Matter is closed. Second option is apply para 46A. Apply para 46A. What does para 46A tell us? Look at what have you purchased or what is the financing instrument that you have used. So the first thing is you are going to use, let us suppose, general loans. You are having a general loan that is taken. So in this particular case, whatever be the fluctuation in the foreign exchange, you will take that to a separate foreign currency monetary item translation difference account. And then you will defer the gain or loss over the tenure of the loan instead of intermediate hit to the P&L. Are you able to follow? Yes.
Yes, sir.
So first thing is you are having a loan which is having the life. So whatever gains and losses are there, you take it in this particular loan. I mean, you book the exchange gains or loss in a separate FCMI TDA account, and that you will release it to the P&L over the tenure of the loan. Are we okay? Yes. Why is this done? Why was this done? To prevent volatility appearing in your financial statements. Do you all believe that today we are in a volatile scenario? Yes? Yes or no? Today's scenario, are we volatile?
I think yes, sir.
Very simple. Your dollar was rupees 90 per dollar about a month ago. Today it is around 94 to 95. It is touching 94, 95 in that range. In 1 month or 1.5 to 2 months, your currency has depreciated. Your currency has depreciated by more than 5%. Can I say that this is an extremely high volatility?
Yes, sir.
Yes. Now, this extremely high volatility is something that uh, made industries go to the MCA and say that, look, this is something beyond our control. So please give us an option not to hit this amount all of a sudden, not to hit the P&L all of a sudden. Let us take it to an FCMI TDA account, and from there we will release it regularly to the P&L. Are you able to understand? Yes. Sure?
Yes. Yes,
Okay.
sir.
All right. Now, if I had taken this loan for a depreciable asset, then what are you going to do? You will be adjusting the forex gain or loss in the PPE itself, in the property, plant and equipment. You will capitalize it. Are we okay? Yes.
Yes, sir.
So from there, it will flow as depreciation. So there will be a systematic recording. So that is the thing that you have as far as forex gain or loss on long-term loans is concerned. Yes. All right. Next. Hmm. Now, let us understand. You are having a forex gain or loss. Okay. You are having forex gain or loss. Option 2, you can take it under previous cap. Option 1, under previous cap, gain or loss taken to P&L. Okay, so let us build this further or extend this example. You have a forex gain or loss. Under previous gap, you were taking it to the P&L. Existing loan, previously, whatever be the volatility, I would absorb in the P&L. Under Ind AS 21, also you will take it to the P&L, and therefore transition provision also says that if previously you were taking it to the P&L, now also you will continue to take it to the P&L. Are you able to follow? Yes.
Yes, sir.
Suppose you have taken a new loan. Okay. This new loan also you will take it to the P&L only. Are we okay with this?
Yes, sir.
Yes. Now, suppose under the previous gap, you had opted for the second option. That means you would spread it over the tenure of the loan or tenure of the asset. So in the case of existing loan, you have availed it before the transition date. And therefore you will be having something known as an FCMI TDA account. Is it okay? So you will take it to that account, and from there you will release it to the P&L. Are we okay with this?
Yes, sir.
Yes. Now, let us suppose I take a new loan after the date of transition. Can I follow FCMI TDA now? Or should I compulsorily take the gap to the P&L?
P&L, sir.
P&L, because under Ind AS 21 or 101, there is no option for us to record it in FCMI TDA or in cost of the asset. Are we okay with this?
Yes, sir.
Yes. Achha. Now, let us look at how the overall situation pans out. Under the previous gap, you had taken option 1, that is move it to the uh, P&L. And under Ind AS also, you will continue under P&L. Is this allowed under Ind AS 101?
Yes, sir.
Yes. Now, in the first case, you have taken the forex gain or loss to the P&L, but after transition, you want to take it to FCMI TDA or capitalize. Can you do that?
No, sir.
No, you cannot. ऐसा option है ही नहीं, right? All right. Next, option 2, previous cap versus option 2 under Ind AS. That means what? Option 2, you have taken the forex gain or loss prior to transition, either in fixed assets or in FCMI TDA. Are you able to understand?
Yes, sir.
Yes. Yes or no?
Yes, sir.
Okay. Now, Ind AS came. And after Ind AS came, can they continue in that same, what you can say, in that same flow that I will take it to FCMI TDA or cost of asset? Can I do that?
Yes, sir. It is allowed.
And that is the relief which is given under Ind AS 101. If you are already booking something in FCMI TDA or in your FCMI TDA or in the asset account, even after transition, you can follow that only in respect of that loan. Only in respect of that loan. It's not indefinite. It's not blanket. Is it okay? Yes.
Yes, sir.
Coming to the last option. Prior to transition, the company was following booking gains or losses in FCMI TDA or in asset. Now they want to take everything to the P&L. Can they do that?
Yes, sir.
Yes, that is allowed. You are moving from something relaxed to something strict. It is always allowed. It is always allowed. Are you able to follow? Yes.
What about the reserves, sir? We will make it zero
Which
because we are
one?
following option 2 in the previous gap, no, sir. So we will have the FCMI TDA reserve pending.
You will move it to reserves.
Okay. Okay.
Okay, because now once you have elected the option to move it to the P&L, henceforth, in fourth option, you cannot keep that reserve, na?
Yes, sir. We will move to retained earnings.
It will go to retained earnings. Yes, it will go to retained earnings. Absolutely right. See, your financials have to be what I can say to a person who already understands the financials. They have to be logical for him. If I am electing for an option to take the difference to the P&L, I cannot keep FCMI TDA at the same time. I will have to push it to retained earnings. Are you able to follow?
Yes, sir.
Yes. Similarly, in the previous case, SBP reserve. Yes. Now, what you need to say is how that SBP reserve and how is my uh, logic working or not working, whatever it is. So if it is not working, you have to ensure it works. Like in the previous case, on the date of transition, options were vested as well as exercised. That means there was no, that means in the previous case, there was no, what is that? 1 second. There was no options on the date of transition, no SBP reserve. Second case, SBP reserve is there, but it will not increase. Why? Because vesting period is over, only exercise is left. So you have a relief. You have a relief that is given. Third case, your SBP reserve is not even fully complete. Transition period, at that time only you are having the exercise period going on. So henceforth, you will still have EBs coming, employee benefit expenses. And therefore, since after moving to Ind AS, you will follow your EBs at fair value. You will follow them at fair value. I cannot keep SBP reserve at intrinsic value. I will have to bring that to fair value to the best possible available data. Are we able to understand?
Yes, sir.
Yes. So that takes care of forex gain or loss. Now, FCTR. FCTR. What do you understand by FCTR?
Foreign currency translation reserve.
That is the full form. But how is it coming into existence?
Mm, due to translation difference.
Yes. Of what?
Mm, loans existing in the balance sheet.
No, this is not loans. Loans is done in the previous case. FCTR arises when I convert the foreign trial balance of a subsidiary or non-integrated operations into the parent for the purposes of consolidation. Yes or no? So you would apply different rates. P&L items, you would take average rates. Balance sheet items, you would take closing rate. Naturally, the trial balance will not match. Are you able to follow?
Yes, sir.
So the difference that is there, that becomes your foreign currency translation reserve. That becomes your foreign currency translation reserve. Are we okay with this?
Yes, sir.
Yes, FCTR. Now, under Ind AS 21, foreign currency, there is no such concept. There is something known as functional currency. There is something known as functional currency. And therefore, what are you required to do? You are required to retrospectively restate FCTR as per Ind AS 21 requirements. All right. Now, if that is not possible, you reset it to 0 on the date of transition. You cannot carry forward the existing FCTR value. Are you able to follow? Yes.
Yes, sir.
Either calculate from retrospective or reset it to 0. You cannot take the existing book value as the deemed value. You able to follow?
Yes, sir.
Yes. Why can I not take previous gap value as my current FCTR? Why can I not take?
Sir, in previous, we are following integral, non-integral method.
Yes.
But now we are using that functional currency.
Correct.
So it is,
And that is why you cannot continue that FCTR balance. It's a new way of calculation that has to be followed. So either go back in time, restate as per Ind AS 21 principles, do the complete working and get that FCTR value, or make it 0. What do you think companies will do?
make it 0.
That's what. So Ind AS 101 is a very peculiar standard in the sense that it tells you where you can diverge from the principles of the other Ind ASs, but only once in your life, which is at the time of adoption of Ind AS. Thereafter, no such adjustments. You have to mandatorily follow the other Ind ASs. Are you able to follow? Yes?
Yes, sir. Yes, sir.
All right. Saminathan, all okay? Yes. Anybody has? Oh, fine. Now, coming to the next one, property, plant and equipment. In this particular case, you are having assets which are already recognized at a particular value. You are already recognized at a particular value. Now, what the standard says is it gives you an option. It gives you an option. You recognize or you have a deemed cost exemption. What do you mean by deemed cost? Whatever is the cost of the asset under Indian GAAP, cost minus depreciation, that net block will become my net block at the date of transition. Are you able to follow? Yes.
Yes, sir.
So that becomes your deemed cost. Carrying amount becomes your deemed cost. It saves a lot of your efforts. It saves a lot of your efforts in having to going back in time and doing the working. But that option also exists. That option also exists. Okay? So that takes care of this one. Next. Okay. Just go through this. I'll be back in a minute. All right, fine. Business combinations. Now, what are the standards that you apply for business combination under Ind AS
103.
103? What was the comparable standard that you had under accounting standards?
Amalgamation, sir, AS 14.
AS 14. Yes. And you would also apply some principles of AS 21. Yes. The consolidation standard.
Yes, sir.
Yes. Okay.
Yes.
Now, if I read AS 14, AS 21, Ind AS 103, and let us assume Ind AS 110 also, do you think the principles are same or different?
Different, sir.
Very different. It's not just normal different, it is very different. First of all, you start with definition of control. What do you understand by control? Power of the investor over the investee in influencing the cash flows and getting the cash flows. Yes or no? So nowhere it talks about a 50% threshold of stake of shareholding. But under AS, you could consolidate only if you held more than 50%. Yes or no?
Yes, sir.
That is the one of the differences. Second, under Ind AS, you had something known as contingent consideration. Yes.
Yes, sir.
Did I have that concept under AS? Answer is no. There is no contingent consideration. You would always have normal consideration, no contingent consideration. So now these were the kind of differences that exist. These are the kind of differences that exist. It is a very vast manner of very vast change that is brought about under Ind AS. Now, what are you going to do? What are you going to do under business combinations? Now, when we talk about business combinations, Let us suppose I have a date of transition. And before that, you have a host of acquisitions that have happened, a host of business combinations that have happened. And they are all part of your group. Now, now, when I prepare the consolidated financial statements as per accounting standards, as at the date of transition, I would have followed accounting standard principles. Yes or no? Yes or no?
Yes, sir.
Yes. But suppose Ind AS 101 is not there and you are transitioning. What you would tell? What you would tell?
Retrospectively, we have to apply all the
Go back in time, one by one, whatever application, whatever acquisition you have done, find out the fair value of assets, fair value of liability, fair value of consideration, contingent consideration, deferred consideration. All these things you find at that point of time. Determine the goodwill from that date for each of the acquisition that is there. Apply it step by step for all the acquisitions and arrive at the value as on the date of transition. Do you agree with this? Yes?
Yes, sir.
Acha. Is this difficult to do?
Yes, sir. Difficult.
Very difficult. It's not easy. In your examination, you have 10 acquisitions, you will be given 10 fair values, 10 deferred considerations, rates of interest, contingent consideration. Everything is given to you on the plate. All you have to do is use your head and solve it. In practical life, it is extremely difficult to go back in time and do a fair valuation of all these things, because the point is nothing is readily available. So now the standard setters felt that they need to ease this. They need to make this process simpler. So what they came up with this, recognize a particular date. Up to which you will not restate any of the business combinations. Beyond that date, if there is any business combination, you will have to do the restatement. Are you able to understand? Yes. Are you able to follow?
Yes, sir.
So you identify a particular date and time. You can give at the time of transition that fact that up to this particular date, all acquisitions will go as per the previous gap regime. And after this date, any acquisition, it will be under the regular, it will be under the Ind AS regime. Is it okay? Yes. So
Yes.
therefore, that is one key benefit that is accorded by Ind AS 101. Okay. So that is done. Next. Second. Yes. So what is important is retrospective amendment is always with effect from a particular date, or if you do not select, you can state that date of transition, effective date of transition itself is your deemed date of acquisition. Is it okay? Yes. So on the date of transition, whatever is the CFS, you don't have to really break your head on that. It will be there. But what is important is identifying that particular date. Okay? Yes. Any doubts here?
Yes, sir. Sir, what is that particular date, sir? Is it like the company decides some date or?
Particular date is a date that the company will decide at its end. Company decided date. Okay. Now, what do you exactly mean by a particular date? Why is there reference to a particular date? If Ind AS 101 had to give a benefit, Ind AS 101 could just have said that assume date of transition to be date of acquisition, and whatever has already happened is we are going to treat that as the date of acquisition and we'll do the accounting accordingly. So this is one way of thinking about it. But they have also told that you can take a particular date. Now, why do you want to take a particular date? Because many times what would have happened is you would have acquired some subsidiaries which are small in nature, which are not huge. Okay. Restating from that date does not make sense. Restating retrospectively does not make sense. You will restate it from the date that you have identified. But you are going to have certain acquisitions which are strategic in nature. So let us take the case where date of transition is, let us suppose, 1/4/2022. Okay, this is your date of transition. Now, I have acquired certain companies, let us suppose on 1/4/2020, 1/4/2017, 1/4/2016, 1/4/2012, 1/4/2009. I have acquired 5 companies. Okay. B Limited, C Limited, D Limited, E Limited, F Limited. Are you okay with this? Yes. Now, let us suppose these 4 companies are small. Okay, these 4 companies are small, not material, not doing anything out of the way in terms of operations. They are normal operating companies. They are making decent amount of profits, whatever they can. And you have acquired these companies. Okay. So these companies are not strategic in terms of vision. In terms of vision, they are not strategic. You have just acquired them to expand your presence. So what would you want to do? What would you want to do? You can say that they have already been accounted under accounting standard. So you can say, I will assume deemed date of acquisition to be 1/4/2019. So what will you do is you will do retrospective restatement from 1st April 2019. You will do the restatement of all these business combinations on 1st April 2019. Are you able to understand? Yes? Yes or no?
Yes, sir.
But 1/4/2020, 1/4/2020, can you say that I will do, one second. Correct. Now, all these subsidiaries, I can take 1/4/2019 as deemed date of acquisition and do the accounting accordingly. Do the business combination accounting. Is it okay? That means you can find the fair value of assets, liabilities, consideration as on 1st April 2019, determine the goodwill, and that will be your business combination accounting for all subsidiaries C, D, E, and F. They are not major subsidiaries, they are not strategic subsidiaries. That is why you have taken a particular date, and from that date, they have been treated as date of when they have formed part of the group. Are you able to follow? Yes?
Yes, sir.
Yes, but
Yes, sir.
this particular asset, this particular company is a strategic acquisition. So you wanted this particular acquisition to reflect the economic realities on the date of acquisition. Is it okay? Yes. So that is why you chose the deemed date of transition or deemed date of acquisition as 1st April 19 to cover the small entities, whereas this entity you will do actual business combination accounting on 1st April 2020 because you want your CFS to reflect the economic realities as on 1st April 2020 in respect of the acquisition of B Limited. Are you able to follow? Yes.
Yes, sir.
That means what will happen is for B Limited, you will find the fair value on the date of acquisition, that is on 1st April 2020. You will find fair value of consideration on 1st April 2020. You will find fair value of net assets on 1st April 2020. If there is contingent consideration, you will find the fair value of contingent consideration on 1st April 2020. All these things you will do it on 1st April 2020, and the difference between consideration and net assets is basically the goodwill. The goodwill represents the goodwill which will appear at fair value on the date of acquisition of 1st April 2020. Are you able to understand? Yes.
Yes, sir.
That is the intention behind this. Otherwise, what is the easiest way for companies to handle this? Companies can say my deemed date of acquisition is 1st April 2022. If they take 1st April 22 as deemed date of acquisition, what are they going to do? 1st April 22, they will calculate fair value, they will calculate everything right on 1st April 22, and then they will do the deemed date of acquisition. 1st April 22 onwards, they will do the accounting. They will take fair value on date of acquisition. They will take fair value uh, of the consideration on date of acquisition. They will find out goodwill on the date of acquisition. Is it okay? Yes.
Yes, sir.
Sure. All right. Fine. Next. Also, what would happen is, understand, what is the benefit or what is the advantage of this particular restatement or this particular what you can say, this particular provision. See, if this provision is not there, I would have to do business combination accounting for F Limited from 1st April 2009. Yes or no?
Yes, sir.
Yes. So on
Yes.
1st April 2009, I would calculate fair value of net assets. I would calculate fair value of consideration. I would do the net assets working. I would calculate the goodwill. Yes, this would be the first thing that I would do. Yes.
Yes, sir.
After that, 2009 to 2022, F Limited is churning profits. So every time I will have to add that profits to my consolidated balance sheet, consolidated P&L. Yes or no?
Yes, sir.
Hmm? So
Yes, sir.
therefore, from 2009 till 22, you would have to calculate the profit as per Ind AS. Then consolidate it into the entity. Then 2011, do the same thing. 2012, do the same thing. So retrospective amendment is a very painful activity because you will have to do that on a repeated basis. Are you able to follow? Yes.
Yes, sir.
Which is why when you fix a particular date, 1st April 2019, so 1st April 2019 is the first balance sheet, is the first date that you can assume this is my date of acquisition. You need not go back in time and calculate the profits and all. Yes or no? Yes.
Yes, sir.
So that is the advantage of this. Yes, Swaminathan, are you clear? Yeah, all clear. Okay, Swaminathan, any doubts? No doubt. Okay. So that was all that you had in respect of business combinations. Okay. Now, there is one exception which is there to this rule. Just a minute. Your question on this. Yes. Okay. A Limited has a subsidiary B Limited. On first time adoption of Ind AS by B Limited, it availed the optional exemption of not restating its past business combinations. However, A Limited in its consolidated financial statements has decided to restate all its past business combination. Whether the amounts recorded by the subsidiary needs to be adjusted while preparing the consolidated financial statements of A, considering that A Limited does not avail the business combination exemption. Will the answer be different if A Limited adopts Ind AS after B Limited? Okay. So now let us understand this question. Okay. I have A Limited is having S1, S2 and B as its subsidiary. Next. S5. Now, Taxation, where the amounts recorded by subsidiary need to be adjusted, considering that B does not avail the business combination exemption. A Limited does not avail the business combination exemption. That means what? It will restate the business combinations. Yes or no? Yes.
Yes, sir.
Whereas B Limited is opting for the business combination exemption. No restatement of past business combination. This is the scenario. This is the scenario. Now, date of acquisition. Let me just add in a couple of things. It is having an entity C. Convertible debentures from 2010. And B is also holding in D from 2010. Convertible debentures 2010 onwards. Okay. Now, understand this. Your date of transition is 1st April 2017. Are you okay with the facts? Yes? Yes?
Yes, sir.
Now, let us talk about B Limited. From when will B Limited start consolidation? Which date onwards? Yes. From which date will B Limited start consolidating? It has availed the exemption, right? No restatement.
Okay. On the date of transition.
Yes. So consolidation with effect from 1st April 2017. Are you able to understand this? Yes. A Limited. When will A Limited do the consolidation from?
As and when the subsidiaries were acquired.
Yes. So in this case, A has acquired C. Example, C Limited since 1st April 2010. Are you able to understand? Etc. Are you able to follow?
Yes, sir.
Okay. Now understand. A's subsidiaries comprises of B, D, S3, S4, S5. Yes or no? Yes, and S1, S2 also. I think let us assume that they are also part of that. Tell me, will all these be consolidated in A's CFS?
Yes, sir.
They will all be consolidated. Will S3, S4, S5 also be consolidated?
Yes, sir. They need to be.
Obviously, because they are all part of the same group. They are all part of the same group. So you will target, you will take these as the target entities for business combination and do the accounting. Is it okay? Yes.
Yes, sir.
Now, now, understand this. B has opted for no restatement. That means, can I say that S3, S4, S5 and D? Can I say that these uh, four subsidiaries, can I say that they are having no restatement? Yes. Can I say that no restatement applies to this by virtue of the choice that B Limited has availed?
Yes, sir.
Yes. But that is holding true from the perspective of B Limited. Ultimately, when I have to look at A Limited, should I go back in time and do a retrospective restatement like how I did for the above?
Yes, sir. For consolidation purpose.
At the time of consolidation, it will go back in time and you will do the restatement. Yes or no?
Yes, sir.
Yes. Now, this would be the scenario if restate, if A moves to Ind AS before B. Yes, A has already applied Ind AS, is a holding company of B. B is opting for no restatement, but A is opting for restatement. Then you will do a restatement if A has moved to Ind AS prior to B. Are you able to understand this? Yes? Yes or
Yes,
no?
sir. Yes, sir.
Suppose B has moved to Ind AS before A. Suppose B has moved to Ind AS before A. Can it happen? Yes. Suppose B has moved to Ind AS before A. That means, in other words, B has transitioned to Ind AS and after that A has acquired B. Are you able to follow?
Yes, sir.
Yes.
Yes, sir.
B has moved to Ind AS and after moving to Ind AS, A has acquired B. Now tell me, B has adopted the policy of restatement on the date of transition. No past business combination restatement. Are you able to understand? Yes. And therefore, what are you going to do? No restatement, restate. Now, in that case, will B do a restatement? Answer is no, because it has chosen the exemption of first, whatever is the, it has chosen the option of restatement from the date of transition, that is 1st April 2017. No prior restatement. Are you able to follow? Yes.
Yes, sir.
Now A Limited acquires B and A Limited has gone for prior period restatement. Can A Limited force B to do a restatement of its own subsidiaries?
No, sir.
No, because in this case, what has happened was B was enjoying the exemption when it was not under the control of A. When it was not under the control of A. After A obtained control of B, you cannot expect B to restate the values since A requires that. No, 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 you do not have to do that. Is it okay? Because it would amount to an excessive amount of changes that you need to carry out. Yes or no?
Yes, sir.
And therefore, if B Limited transition to Ind AS and then acquired by A, there is no requirement for B to do a retrospective restatement. Is it okay? Yes.
Yes, sir.
But if A acquires B and at that point of time, they are both uh, under Ind AS and uh, A Limited has opted for retrospective restatement. Then it will do the retrospective restatement. Are you able to follow? Yes? Clear? Absolutely clear business combinations?
Sir, that means for B Limited, it has to follow exemption for standalone and do retrospective restatement for consolidation, sir.
Yes. Yes. In which case?
When both are in Ind AS regime.
Yes. Yes. Is it okay?
Yes, sir. Then what is the benefit, sir? It has to do twice the calculations, no, sir. It would be better from the first it follows the retrospective
1
restatement.
second. What did you say? Apply SFS. Could you please repeat?
Yes, sir. Sir, when both are following Ind AS and A Limited is opting for retrospective restatement and B Limited is opting for exemption.
Yes.
Then for the purpose of consolidation, B Limited also has to do retrospective restatement, no, sir.
Because of A Limited's policy.
Yes, sir. Yes, sir.
Yes, it has to do. Because in this case, what has happened is ultimately the subsidiary must align itself with the requirements of the parent. Yes.
Yes, sir.
So in spite of the fact that B has opted for the exemption while it is doing its consolidation, it has to do a second round of retrospective restatement because it has to align itself with A Limited's principles of retrospective restatement. Did you follow?
Yes, sir. Yes, sir. That is what I'm telling.
It
Like
has
it
to
has
do
to do
twice. It
twice
has to do
again.
twice. No option.
Yes.
No option. Matlab the see in real life nobody will do like this. The point of this is just to say that in all what are the scenarios in which you can do a retrospective restatement or be safe from a retrospective restatement, right?
Yes, sir.
So if you look at this scenario, do you think any company will actually go back in time and do a retrospective restatement?
No, sir.
Nobody will do. Nobody will do. Everybody will opt for that exemption, that benefit, which is basically taking date of transition as your deemed date of acquisition. And from that date onwards, you do the consolidation. That is going to be the norm in which it will be handled. Is it okay?
Yes, sir.
Yes. Any doubts on business combination?
Clear, sir.
Clear. Swaminathan, any doubts? No doubts? Okay. Next, let us move on to the next one, that is compound financial instruments. Typically, your convertible debentures, these items, or convertible preference shares, these are items which you would be showing them as loans or share capital respectively under AS. But now here they are having two components. One is an equity component, one is a debt component. So you are going to record this at uh, you are going to record this as a compound financial instruments on the date of transition. That is clear. Now, how am I going to record it? You will have to record it right from the very beginning. You will have to record it right from the very beginning, do the calculation. And with the help of that calculation, whatever is the amortized value on the date of transition, you will assign that to the instruments, and the differential whatever is there, that will go to retained earnings. Are you able to follow? Yes. So in this particular case, let us take, I have an instrument with a face value 1 lakh, coupon 7%, market rate is 10%, optionally convertible with tenure of 5 years at the option of the holder. So previous gap, you would treat it straight away as bank account debit to convertible debentures 1 lakh. Are you able to follow?
Yes, sir.
Yes. But under Ind AS, can I book it like this? Answer is no. You will have to take it to split accounting principles. So what you will do is 1 lakh into 7%. This is your coupon into 3.7908. So that gives you uh, the first discounting that you are doing of the interest plus the principal 1 lakh into 0.6209. So that comes to 88,626. Are you able to follow? Yes.
Yes, sir.
So what would have been your entry if it was under Ind AS? Bank account debit 1 lakh to liability component 88,626 to equity component 11,374. Are you able to follow up till now?
Yes, sir.
Yes. Now you prepare amortization table, opening balance, EIR, coupon, closing, ET balance. Yes. So at the end of year 2, your actual closing value should be 92,538. Do you agree with this?
Yes, sir.
Bolo. Do you agree? 92,538. And your equity component remains at 11,374. No change in that. So what you will do is, you have already booked convertible debentures at 1 lakh rupees. You will remove that. So convertible debentures account debit 1 lakh. You will replace it with liability component 92,538 and 11,374 equity component will be there as it is. Equity component will be there as it is. Are you able to follow? Yes.
Yes, sir.
The difference, as usual, will go to retained earnings. This is entry on the date of transition. Any doubt so far?
Clear,
Lavanya,
sir.
Yes,
clear?
sir.
Okay.
Yes.
All right. Fine. So that takes care of compound financial instruments. Okay. So we take a quick break, or 1 second before a break. Let me see if you can try this one question. I want you to try illustration 15. 1 5. Is illustration 15 visible? Yes?
Yes, sir.
Yeah, I want you to try this out. Avoid looking at the solution. Try this out.
Yes, sir. Sir, I got on date of transaction liability amount is 30 lakh 27,666.
Yes, that's right. 30 lakh 27,666. Yeah. So what is the entry that you would be passing? on the date of transition? Yes. What is the equity component? You got the liability, so you must have gotten the equity as well.
Credit financial liability with 30 lakh 27 triple six.
That's right.
Equity 4 lakh 85 400.
485. How come 4 lakh 85?
So 30
See,
lakh
your issue proceeds were 30 lakhs,
1 lakh
correct?
80 400. 1 lakh 85 400.
1 lakh 85 400. Yes. But 30 lakh 27 triple six liability component, 185 400 equity. Convertible debentures you will debit with 31 lakh 50,000. Why 31 lakh 50? Because 30 lakh was your face value. You would redeem it at a premium of 10%. That is what the question has said, right? Yes.
Yes, sir.
Has issued at a premium of 10% after 4 years, 20x1 till 20x5. So 2, 3, 4, 5. So 4 years. And you are at the end of 2 years. So 3 lakh premium. After 2 years, it will be worth 1 lakh 50. So under AS, you would have taken it as 1 lakh 50, 75,000 per year. You would have recognized the interest cost. So therefore, the debentures would be appearing at 31 lakh 50. So you would debit 31 lakh 50, credit liability 30 27 666. You would credit the equity 185 400. Differential 63,066 would be go to your retained earnings. Is it okay?
Yes, sir.
Yes. And what is that 63,066 retained earnings? That is nothing but under Ind AS, the total of your interest for the first 2 years, 5,73,066, and the total of your interest under AS, 5,10. The difference between these two becomes your uh, retained earnings adjustment, 63,066. Are you okay with this?
Yes, sir.
Yes. Swaminathan, you are there? I hope he's able to answer. Fine. Next. Let us move on to the next one. You were there, Lavanya, when we were doing this chapter?
No, sir. I was for live class.
Okay. You did it later on, huh?
Yes, sir.
Okay. Fine, fine, fine. Okay. Now, we move on to the next one, that is investment in joint ventures. Okay. So the point with joint ventures is, see, under your accounting standard regime, joint ventures, you would typically do something known as a proportionate consolidation. You know what is a proportionate consolidation? Wherein whatever is the share of the entity investing in the joint venture, you would take that much of assets, that much of liabilities, that much of income, that much of expense, you would record it in the consolidated financial statements. That means you would do a line by line consolidation under AS 27, but it would not be full complete. It would be based on the percentage of your interest in the joint venture. Are you able to follow?
Yes, sir.
Yes. But under Ind AS, do I have a concept of proportionate consolidation for a joint venture? Answer is no. You follow something known as equity method. So what you have to do at the time of transition is that you will have to de-recognize the individual assets and liabilities that were accounted under AS, and you have to recognize investment in the joint venture as the balancing figure. That is going to be the way you will do the treatment. Is it okay? Yes.
Yes, sir.
So under AS, whenever they ask you about a joint venture, you will look at first one. From AS, that means the existing balance sheet already includes the impact of the items consolidated. So what are you supposed to do? You are supposed to remove those items which are already forming part of the consolidated financials. And from there, you will then move on to uh, uh, eliminating all of that in the entry. The balancing figure would represent your investment in the joint venture as a single line item, which is exactly how the equity method expects you to follow in terms of accounting for a joint venture. Okay? All right. So I think this question we can skip. It's a very routine question. So this question let us skip and move on to the next one. That is what is this illustration 16? Okay. Now, loan taken from the government. Loan taken from the government. This would typically involve loans which are obtained at extremely low rates of interest. Okay, this would amount taking the loans at absolutely low rate of interest. So there are two options which the standard gives you. One is a prospective application. The other is a retrospective restatement. So in prospective application, you will continue to recognize the loan as a financial liability or equity as per previous gap value. Do not use any other adjustment or not. Just take the previous gap value, and grant is not recognized for the benefit arising due to below market rate of interest. So that is prospective application. Retrospective application means you will have to go back in time, determine the market rate of the loan on the date it was advanced, and then you will have to uh, do the accounting accordingly. So now, for example, let us take a loan of 10,000. Coupon is 2%. Rate of interest is 10%. Tenure is 5 years. Under AS, I will recognize the loan at 10,000 rupees. Over. And if you are going for the prospective application, you will also recognize it at 10,000 rupees only. That's it. But if you go for retrospective, then since the data is given, you can find the fair value of the loan. So fair value of the loan will be 10,000 into 2% into 3.79. That is 2% is your interest rate, coupon rate, and 3.79 is the present value annuity factor, plus 10,000 into 0.621. This is the end of the loan cash flow. Okay, so 6,968 becomes your loan. Deferred government grant 3,032. So you have bank account debit 10,000, 6,968 and 3,032. Are you able to understand this? Yes.
Yes, sir.
So you can go for the second option as well. You can go for the second option as well. But normally, in view of the benefit given by the Ind AS, companies will prefer the prospective application only. All right. So with that, I think we have concluded major part. Now only accounting estimates are left, and then we shall pick up a couple of questions before winding up. Otherwise, almost everything is covered. So we take a 15-minute break. It's 9, so we shall it's 8:55. Okay, so we shall convene at 9:10, and then we shall continue the remaining part with some questions. Is it okay?
Yes, sir.
Okay. Break, please. part that we have left is accounting estimates. So, what Ind AS 101 tells us is you cannot take the benefit of hindsight bias. So, for example, you are aware that we need to do a retrospective application of Ind AS at the time we are adopting Ind AS. So, suppose I come across an item for which my estimates have gone a little haywire in the current year. So, when I'm restating retrospectively, I want to change that estimate at that point of time. Ind AS 101 says you cannot do that. You cannot do that. Why? Because that is a hindsight bias that you are introducing in the financial statements, which is not right. Which is not right. So, what does it mean? For example, if you are preparing Ind AS financials for the first time for 22-23, you get an opportunity to restate your P&L for 21-22 for all the Ind AS adjustments. Let us suppose your bad debts provision in the transition year, your bad debts provision made on 31st March 2021 was 2 lakhs on 31st March 21. Actual bad debt in 21-22 is 3,50,000. Now, you want to go back in time and restate this. So, do you prepare a balance sheet on 1st April 21? When I'm doing my transition, do I prepare a balance sheet on 1st April 21? Tell me yes or no. Tell
Yes,
me
sir.
yes. So, what companies would want to do is they do not want to show this 1,50,000 bad debt. Bad debt is something which is not nice to have on the books. So, what they say is we will go back in time, 1st April 21. We are already having provision for doubtful debts appearing at 2 lakhs. We will make this 3.5 lakhs and we'll change the retained earnings. We will take the adjustment, but as an estimate adjustment, and we will not take the hit to the P&L of 1,50,000. Can I do that? Answer is no. Because this is something that is arising out of a hindsight bias. You went ahead in time and now you are seeing, sitting here, you are looking at the back and saying, oh, the estimate was wrong. I should have changed the estimate. That is because new facts have come for which you were not responsible at that particular point of time. So therefore, you cannot do that adjustment. Hindsight bias is totally not permitted. And therefore, you will account for that 1,50,000 in the current year only. That is the 1,50,000 you will record it in the current year as an expense. Are we okay with this? Yes.
Yes,
Yes.
sir. Yes, sir.
All right. So estimates required by previous gap. Yes. If there is evidence of error, then make an estimate without a hindsight bias. If there is no evidence of error, is it consistent with Ind AS? Yes, use the previous estimate. If no, then use previous estimate and adjust to reflect Ind AS. Important point is do not go back and restate. Do the adjustments in the current period only because that is what it actually is. That is what it actually is. Okay, so with that, I think largely we have covered whatever needs to be covered on the concepts portion. So, what are the cases that we have covered today as a revision? We started up with ESOPs. From ESOPs, we went to foreign exchange. From foreign exchange, we went to property, plant, equipment. From PPE, we went to business combinations. Then we went to financial instruments. Then we went to government loans. Then we discussed hindsight bias, accounting estimates, and yeah, I think what else? And investment in joint ventures. So these are typically the questions that you would be expecting in your examinations. So just be kind of prepared for this. Largely, the theory, whatever had to be discussed is discussed. If you have any doubts, please let me know. Any doubts, any queries on what we have covered so far? Else we'll move to doing the questions.
Clear, sir.
Clear? Okay, fine. So now let us move on to the questions. Okay. Okay. So let us pick up this question. Hin Limited, having a net worth of 250 crores, is required to adopt Ind AS from 1st April 20X2 in accordance with the company's Indian accounting standard rules. Rahul, the senior manager of Him Limited, has identified following issues which need specific attention of the CFO so that the opening balance sheet as on the date of transition can be prepared. As part of property, plant and equipment, company has elected to measure land at fair value and want to use this fair value as the deemed cost on the date of transition. Carrying value of land as on the date of transition was rupees 5 lakhs. The land was acquired for a consideration of rupees 5 lakhs. However, the fair value of land as on the date of transition was rupees 8 lakhs. Can the company adopt? So tell me, can the company adopt fair valuation for the purposes of Ind AS 101 going forward?
Yes, sir.
Yes. So when they will adopt fair valuation, that is a base of accounting. So you have taken a stand that I will follow revaluation model, which is okay. So now the movement is 3 lakh rupees. Your land worth 5 lakhs is now worth 8 lakhs. So entry will be land PPE account debit
To
3
retained
lakhs.
earnings.
To you can take it as retained earnings, but institute has taken it to revaluation surplus, which is also fine. Okay. But yeah, the whole point behind taking it to retained earnings is that this is on account of Ind AS transition, right? I mean, moving to Ind AS. So that is also one more view that typically is possible. Okay. That is totally fine. So you can take it to retained earnings as well. Any doubts?
No, sir.
Okay. Under AS, the company has designated mutual funds. Under Ind AS, the company has designated mutual funds as investments at FVTPL. Okay. The value of mutual funds as per previous gap was rupees 4 lakhs and the fair value is rupees 5 lakhs. So what are you going to do? What would you be
We,
doing for second one?
we will restate it to fair value.
Restate it to fair value. Investment in mutual funds to retained earnings, 1 lakh. Are we okay with this?
Yes, sir.
Yes. Okay. Company had taken a loan from another entity. The loan carries an interest rate of 7% and it had incurred certain transaction costs while obtaining the same. It was carried at cost on initial recognition. Principal amount is to be repaid in equal installments over the period of the loan. Interest is also payable at each year end. The fair value of the loan on the date of transition is 1 lakh 80 as against carrying amount which at present equals rupees 2 lakhs. You have a loan, cost is carrying amount is 2 lakhs, but fair value is 1 lakh 80,000. What do you do?
We will reduce it to 1,80,000.
You will reduce it to 1 lakh 80,000 because financial liabilities, you will have to recognize it at fair value. Yes or no? Yes.
Yes, sir. Yes, sir.
And these expenses, whatever are incurred, they will be adjusted against the loan balance under Ind AS. Okay, so the entry will be uh, borrowings debit to retained earnings, 20,000. 20,000. Are we okay with this?
Yes, sir.
Yes. Company has declared a dividend of 30,000 for the last financial year. On the date of transition, the declared dividend has already been deducted from reserves and regrouped under provisions and grouped under provisions. Dividend was only declared by board of directors at that time and it was not approved in the AGM of the shareholders. Subsequently, it was ratified by the shareholders. So what are your thoughts?
Uh, Dividend payable needs to be reversed.
Yes. Why?
Uh, in Ind AS, we will book for dividend only when it is ratified by the shareholders.
Correct. So entry will be provisions account debit because it's sitting in provisions, and credit will be retained earnings. Is it okay?
Yes, sir.
30,000. All right. Next. The company had acquired intangible assets as trademarks amounting to 2 lakh 50. Company assumes that these have an indefinite useful life. The fair value of the intangible assets on the date of transition was rupees 50,000. Sorry. Oh, fair value was 3 lakhs. However, the company wants to carry the intangible assets at 2 lakh 50,000 only. Yeah.
No adjustment required, sir, as it
No,
can carry as per previous gap.
you can carry as per the previous cap. No impact. It's not necessary to do anything. Okay. After consideration of possible effects, the deferred tax impact is 25,000, increasing the portion of DTL. No requirement to carry out separate calculation of deferred tax on account of Ind AS adjustments. So what will you do with this? Book deferred tax, right?
Yes, sir.
25K to DTL. Are we okay? Management wants to know the impact of Ind AS in the financial statements of the company for its general understanding. Prepare Ind AS impact analysis report, wherein you are required to discuss the corresponding differences between earlier cap and Ind AS against each identified issue for preparation of transition date balance sheet. Also pass the journal entry for each issue. Okay, so I think we have covered up this in totality, right? No doubts. So let us move on to the next one. Okay. Yeah. RTP question. GG Limited, a listed company, prepares its first Ind AS financial statements for the year ended March 20x3. The date of transition is 1st April 20x1. The functional and presentation currency is the rupee. The financial statements as at and for the year ended 31st March 20x3 contain an explicit and unreserved statement of compliance with Ind AS. Previously, it was done using GAAP as the base. It has already published the first interim results of quarter 1 to 3 of 20x2x3 in accordance with Ind AS 34 and Ind AS 101. The interim financial report included the reconciliations both of the total income and equity that are required by Ind AS 101. Since issuing the interim financial report, its management has concluded that one of the accounting policy choices applied at interim should be changed for the full year. How should GG Limited deal with the change in accounting policy under Ind AS frame? Yes.
Sir, I think like same accounting policies need to be used for interim financial statements
Same
as well.
accounting policies need to be.
Used when preparing interim financial statements, sir.
Yes, in the interim also they have to use the same financial statements. Yes.
Yes.
Now, what have they done? It has already published its first interim results. One of the accounting policy choices applied should be changed for the full year. Now, what they should give then? If they have decided to make it for the full year, then explanation of the change in the policy should be given that it has made in the interim financial report. Disclosure note will include information as to why what Ind AS 8 would otherwise require. And you should also prepare the reconciliation of total comprehensive income and of equity. Is it okay?
Yes,
Yes.
sir. Yes, sir.
Yeah. So pretty straightforward. Okay. Read this question and tell me.
Sir, for associate social welfare limited, Ind AS will be applicable.
For whom? For Social Welfare
Welfare
Limited,
limited,
Ind AS will be applicable. Okay.
as it is an associate company,
Yes.
and for vegetables logistics associates,
For Vegetable Logistics Associate,
uh,
two
I'm not
scenarios. If it is operating as a joint operation, it is not applicable. If it is applying, if it is running as a joint venture, then Ind AS will be applicable. You are aware of a difference between a joint operation and a joint venture?
Yes, sir.
Yeah. So basically, let me know what is the difference.
So, for joint venture, they will follow that equity method of accounting.
Okay. And
And
joint operation?
joint operation, like two parties carrying on operations together, and they are mm,
Basically, when we talk about, so this broadly comes under your Ind AS 111 that deals with joint arrangements, right? So joint arrangements gets categorized into two classes. One is a joint operation, one is a joint venture. In a joint operation, what happens is two or more parties come together, carry out whatever activity is there without forming a separate entity. Okay. So in accounting terms, what they say is in a joint operation, the members of the joint operation, that is the joint operators, are entitled to their share in the assets and liabilities of the joint operation. Is it okay? You understand the language,
yes,
right?
sir. Yes.
They are entitled to their share of assets and liabilities in the joint operation. Whereas in the case of a joint venture, the joint venturers are entitled to their share of net assets in the joint venture. So the first implication will be, वहां पे you say entitled to their share of joint of assets and liabilities of the joint operation. Here you are saying entitled to their share of net assets. What is the difference? It's a big difference. In a joint operation, you typically do not create a separate legal entity. You just come together, join hands, carry out the operation, and move out after taking your share of profits. Examples, you have your recently concluded T20 World Cup, right? T20 World Cup was jointly hosted by India and Sri Lanka. So they came together, BCCI from our side, Sri Lankan Cricket Board from the other side. They came together, pooled their resources. Sri Lankan Cricket Board offered its own hotels, its own stadiums, and same for the Indian Cricket Board also. And whatever is the profit that they generated, depending on what was their agreed turnover, they just pull that profits and they go out. There is no separate legal entity that was formed for this purpose. Are you able to follow? But
Yes, sir.
in the case of a joint venture, you would be having a separate legal entity that gets formed. Okay. Uh, One of the last examples is your Vistara. Vistara was an airline which was a joint venture between Tata's and Singapore Airlines. So they came together, joined hands, contributed towards equity share capital of Tata Singapore Airlines Limited, and that Tata Singapore Airlines was running out the operations of Vistara. So therefore, that is a joint venture. For Tata Singapore Airlines Limited, you would typically be having Ind AS applicable because it is a separate legal entity. But for the purposes of uh, what you can say joint operations, you will not apply Ind AS. To what will you apply? That is the question. To what will you apply? The operation is not a uh, what do you call, the operation itself is not through a separate legal entity. So that is why you cannot apply it, and hence it will be outside the purview of Ind AS. Are we okay with this?
Yes, sir.
Yes? All right. Fine. So that takes care of uh, that part. Next. Okay. All right. So this is one very good question that is there, but before that, anything else do I have to give? No, this is enough. Shaurya Limited is a company having registered and corporate office at Delhi. 60% of its shares are held by Government of India, rest by other investors. This is the first time that Shaurya would be applying Ind AS for preparation of its financials for the current year 20x3x4. Following balance sheet is prepared as per earlier gap as at beginning of the preceding financial period, along with the additional information. So these are the things which are given. Next. Additional information, all figures in thousands. Other current liabilities include 3,90,000 to be paid in cash, such as expense payable, salary payable. 60,000 are statutory government dues. Long-term loans and advances include 40,000 loan, and the remaining amount consists of advance to staff. Other non-current assets of 2 lakhs consist of capital advances to suppliers. Other current assets include 3,50,000 current assets receivable in cash and prepaid expenses of 50,000. Short-term provisions include dividend payable 2 lakhs. The dividend payable had been as a result of board meeting wherein the declaration for X1, X2 was made. However, it is subject to approval of shareholders in the final AGM. CFO of Shaurya Limited also presented the following against corresponding relevant items. PPE consists of a class of assets as tuition buildings whose carrying amount is 10 lakhs. However, fair value should be 15 lakhs. Company wants to follow revaluation model as its accounting policy in respect of its property, plant and equipment for the first annual Ind AS financial statements. Fair value of intangible assets as on the date of transition is estimated to be 2,50,000. However, the management is reluctant to incorporate the fair value changes in the books of accounts. Shaurya Limited had acquired 80% stake in a company a few months earlier, thereby acquiring the role upon it at that time. Shaurya Limited recognized goodwill as per erstwhile accounting standards by accounting the excess of consideration paid over net assets acquired at the date of acquisition. Trade receivables includes an amount of 20,000 provision for bad debts. As per latest estimates, you need to increase it to 25,000. Company had given a loan of 1 lakh. Transaction costs were separate. Loan given for transaction cost. People interest is payable at each year and fair value is 50,000. Ind AS 109 requires to recognize interest as per EIR. Management says it is a tedious task to apply and hence is reluctant to apply the same retrospectively. They cannot go for that argument. In the long term, borrowings 4,50,000 is towards state government, interest payable at 4%. In the prevailing rate is 8%. The fair market value of loan stands at 4,20,000 as on the relevant date. Under previous cap, mutual funds measured at cost or market value, whichever is lower. So this is given. Separate deferred tax adjustment sheet is given. Prepare the transition date balance sheet. Okay, fine. All right. So now, how do we start off? We move on with the adjustments one by one. Yes or no?
Yes, sir.
Yeah. Largely, you should be okay with the format of the financial statements. That should not be much of an issue. Okay. So additional information notes 1 to 4, whatever is given, these are items that get reclassed. Okay. Now, when they get reclassed, you will have to move them from what you can say, you will have to move them from where they are currently sitting to the new account code where they should be sitting, okay, to the new category where they should be sitting. Okay, so that is one activity that you will have to do. So this part you can have a look at it for homework. Okay, I need not give this. Okay, next. Plant equipment consists are at 10 lakhs. The fair value of the office building is 15 lakhs. They want to apply a revaluation model for the first Ind AS financial statements. So what is the entry that will be passed here? 10 has to become 15.
PPE account debit to retained earnings.
Yes. So PPE to reserves. How much? 5 lakhs. PPE to reserves, 5 lakhs. Next. The fair value of intangible asset is estimated to be 2,50,000. Management reluctant to incorporate the fair value changes in the books of account. So this previous cap value continues, no change. Okay. Shaurya had acquired 80% shares in Excel, thereby acquiring control. Shaurya recognized goodwill as per accounting standards by accounting excess of consideration paid. Fair value was not done at the time of acquisition. Okay. There is no data for any modification, so previous gap value will continue for this. Okay. Trade receivables include an amount of 20,000 as provision. As per latest estimates, provision needs to be revised to 25,000. Is it okay? Yes.
Yes, sir.
What do you think for this one?
It is an accounting estimate, so we have to use the same value, 20,000, sir.
You will have to use the same value of 20,000.
20.
Yeah. 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 All right. So if you move it, it becomes hindsight bias. Okay. Hindsight bias. Okay. Next. Company had given loan of 1 lakh. Transaction cost separately incurred. Loan carries interest rate of 7%. Fair value of loan is 50,000 as against carrying amount of loan, which at present amounts to rupees 40,000. However, Ind AS 109 mandates to recognize the interest income as per effective interest method after the adjustment of transaction cost. Management says it is a tedious task, in which case to apply effective interest rate with a retrospective effect, and hence is glowing is reluctant to apply the same in the first time adoption. So in this case, fair value of loan is 50, carrying amount is 40. So you will have to enhance that. So the entry will be
Retained earnings 10,000 to loan.
1 second. Yes, the principal amount is to be repaid. Interest is also payable. Fair value on the date of transition is 50,000 as against carrying amount of 40,000. Yes. So the entry will be a minute. $50,000 as against the carrying amount, which currently amounts to what is the adjustment entry that you are looking at?
Loan account debit to retained
Loan
earnings.
account debit to retained earnings. Or this is loan given 10K. Yeah. All right. So that is this one. In the long-term borrowings, 4,50,000 of component is due towards the state government. Interest is payable on the government loan at 4%. However, prevailing rate in the market is 8%. The fair market value stands at 4,20,000 on the relevant date. So what are you going to do with this? You need the interest rate prevailing at the date when you have taken the loan. That is very clear as far as the adjustment for government loans is concerned. In this particular case, that information is not available. Present rate is 8%. This is not the rate prevailing on when the loan was taken. So therefore, the loan will continue to be carried at previous cap value. Are you able to follow?
Yes, sir.
Previous cap value. Under previous cap, mutual funds were measured at cost or market value. Under Ind AS, they have been taken as FVTPL. Value of mutual fund is 2 lakhs. Fair value is 30,000. The value of mutual funds as per previous cap is 2 lakhs. Fair value of the mutual funds is 2,30,000. So we will have to bring this towards fair value, right? So investment account debit to retained earnings. Yes or no?
Yes, sir.
30,000. Net deferred tax income. So this will give rise to deferred tax asset or reduction of a deferred tax liability. What do I have in the question? Deferred tax liability 3,50,000. So this will be reduced. DTL to retained earnings. 50,000. So with this, I think all adjustments are taken care of. You should be in a position to prepare the balance sheet as per Ind AS. Yes or no?
Yes, sir.
Yeah. All right. Fine. So try to prepare the Ind AS balance sheet of Shaurya Limited. Okay. So this we leave it. It's done. Okay. Now, what else is there which we can cover? Okay, I would suggest you go through this question also as part of your homework. This is also a very good key question that you can revise. Okay, all right, fine. Yes. Okay, I think more or less we are done. We did one big question, we did couple of small questions. So that's about it. Yeah. Okay. So anything else you would like from my side, Lavanya?
Clear, sir.
All clear?
Yes,
So
sir.
you are answering this attempt, May 2026.
No, sir. I have to give September attempt, sir.
You are answering for your September. Okay. So, okay. But you have seen the larger version of the regular version of this session on Ind AS 101.
The recorded classes I have gone through, sir.
It was 3 sessions, right?
Yes, sir.
Yeah. So I think there, of course, we have that is a regular batch. This is a revisionary. So today I had to just rush through a lot of things. But there, I think we had covered these things in quite long detail. And therefore, I think in that sense, that provides a lot of uh, clarity or lot of explanation. Yes. So
Yes.
major points that you have to just remember is this standard largely it is practical oriented. From examination perspective, your key chapters are financial instruments, consolidation, property, plant, equipment, which includes borrowing costs. And also it could be including certain of your chapters like share-based payments. These are chapters where questions almost keep repeating at least in every alternate attempt, if not every attempt, right? That way, your Ind AS 101 only does not get repeated quite a number of times. Okay, so in that sense, you have a lot of uh, major chapters that you would already have studied, right? So, consolidation, financial instruments, PPE, these chapters typically cover around 60 marks of your paper altogether. Okay, so in that sense, uh, those were also done for the revision, so I think you would be okay with that. Yeah, and that's it from my side. If there is anything, let me know. Otherwise, we can wind up the session.
Yeah, as of now, clear, but I have to prepare from my side.
You will have to.
Prepare from my side, sir.
Yeah. So September, right? Yeah, I think there is
Yes.
still some time, but good. You are almost on the closure of. You've attended all the sessions, huh?
Yes, sir.
Very good. So I think you are quite comfortable in the sense that your syllabus is almost drawn to a closure, a well-drawn closure. Yeah, you have time to sit and revise. Yes. Okay. Okay. So all the very best, whoever will watch, all the very best for your May 2026 exam. And those who are going to watch beyond that, who are going to answer beyond May 2026, for them also all the very best. And if there is anything, I think you can reach to the institute and we can help you out with any doubts or queries that you would be having. Apart from that, uh, nothing else. from my side. I think, yeah. So thanks everyone, and have a good day. Session is concluded from my side. Okay. If there is anything, then let me know. Okay. All right. Session conclude कर सकते हैं.
Yes.
Yes, yes, yes. Thanks. Thank you. Thank you. Have a nice day.